Welcome investors. With this week's inflation report and retail sales number, which is essentially consumer spending, I believe we might be at an inflection point. In today's video, we're going to talk about what the data released this week and how it impacts commercial real estate and how it impacts banks. First, we need to look at what the data actually said. So I'm going to put up on your screen here this Market Watch article. And in this column here, I highlighted is the actual number. In this column over here is the median forecast, which is the numbers the economists and analysts agree on. All right, so the expectation for inflation was 0.3 month over month, and we got 0.4, so a little bit higher than expected. And then let's move down to retail sales, and it is expectation negative 0.3 over month, and we got negative 0.8. And again, we're going to go over these numbers a little bit more, but let's take a look at this this retail sales article by MarketWatch. Retail sales in the U.S. post biggest drop in 10 months. Now, we'd expect the drop when we just had our holiday spending, so a decline month over month, historically, seasonally. This is kind of to be expected. Not a drop of this significance, though. It was a major drop month over month. When we see these negative numbers, again, that just means, for example, we spent $100 last month, and 8% less, we spent $92 this month. So pretty simple as that. And now that first category we talked about, which was CPI, Consumer Price Index, that is inflation, and it was a month over month was just a little bit higher than expected. We still got inflation. That inflation number month over month was a little bit higher than expected. Does that change the dynamics of, oh my gosh, inflation was coming down over last year, but now it's starting to go back up? Is that really the case? Just because we had a 1 month a little bit higher than expected. Let's take a quick look and see what inflation has been doing over time. All right, so what I have here for you is the U.S. Bureau of Labor Statistics. And this chart down here, what we're going to take a look at is 20 years worth of inflation data, going back to 2004. We're going to take a look at a little bit more recent time frame to see if we can get a trend. So we're going to start with April 2022, and what has been happening since then? Inflation has been trending down. You know, we're going to have a little hiccups. We're on our way down, and any markets, if we're coming down, we're not coming down generally in a straight line. It'll have, one little up month and then down and then up and then down continuing. It's just like with the stock market. I mean, if the trend is up, you're still going to have months where you're coming down. It's just natural with markets, but we can clearly see that inflation is in fact coming down. Well, the data is. So what does that mean for the Fed? What does this 1 month of hot inflation, what does that mean the Fed is going to do? Likely doesn't change the timeline on when they're going to raise rates unless we see multiple months of higher than expected inflation. Then they're going to push this rate cutting cycle timeline down. Right now, our expectation May, June, latest July right now. That can change if we start to see inflation tick back up. But I don't think that's going to happen, and that's because of retail sales numbers, which is consumer spending. Consumers' spending is slowing down. And one thing we need to keep in mind when it comes to down markets, recessions, consumer spending makes up 65% of GDP. GDP is the number we use to say, hey, we are in an economic slowdown, we are in a recession if we get negative GDP. What makes up the rest of the GDP? A lot of it has to do with government spending. And the government is spending like wildfire. I mean, we have an election this year, so you got to expect the government is going to continue spending. But still, consumer spending makes up the majority of that metric. And if consumers are slowing down spending, that's going to pull down inflation because there's no longer a giant demand for products. Another reason we may have got a high inflation report is generally at the beginning of the year, retail companies, manufacturing companies, businesses raise their prices at the beginning of the year going into the new calendar year. So that could be that seasonal spike, and I don't think that trends continue. And we see a lot of consumer debt. So that's going to put a damper on consumers being able to spend. I mean, we have over $1 trillion in credit card debt, an historical high. So I think this is kind of a blimp in the radar. I think the trend of inflation is going to continue to come down unless we have some geopolitical event that causes energy prices to skyrocket, causes supply chain issues, and then we have to reevaluate our thesis and our time frame on a lot of different things. But if things stay status quo that they are right now, inflation comes down, consumers continue to slow down their spending, thereby the Fed doesn't need to hike rates, but can continue on their time path of cutting rates sometime in the summer. That's what it's looking like right now. But again, the markets were expecting them to cut rates here in March. That's just pretty much off the table right now. And the markets responded one day, but they are still very optimistic that we're going to either get a no landing or a soft landing. But folks, rates are going to remain higher for longer, and maybe that can does get kicked down the road further if we continue to see economic strength. But I don't necessarily believe that's going to take place. But this is our U.S. economy is a giant destroyer ship. And it takes a long time for it to really turn. But I mean, we're starting to see it turn, but it still takes time, and maybe the rates don't get cut till a couple months later. So what's the impact on the commercial real estate, the real estate market in general, and banks, which we talked about at the beginning of the video? What does the data tell us? Why is it going to impact those sectors so much? I want to start with commercial real estate because that is the driving force for banks. And banks are the driving force for not only the U.S. economy, but the world economy as a whole. So we'll touch on a little bit of moving parts that are going on right now. So let's take a look at this article here. And this $929 billion in commercial loans are set to mature in 2024. Almost 1/5 of outstanding commercial real estate debt is due to mature this year, a total of $929 billion in debt obligations that will require buyers to refinance or sell their properties. 1/5 of commercial real estate is up. They have to refinance these loans. A lot of these commercial real estate investors and big giant corporations bought these commercial real estate buildings in the 2020, 2021 coronavirus pandemic interest rate time frame, which rates were near zero. All of a sudden, they've leveraged themselves to buy all this commercial real estate, and now they have to refinance at a much higher rate. Commercial real estate loans are 7, 8, 9%, and some of them are getting loans in the gray market, and they're getting hard money loans, which are even higher, 10, 11%. So it doesn't make sense for a lot of these commercial real estate investors to refinance at such higher rates. So maybe they just let it go. Maybe they sell off the property at a severe discount. We're seeing this take place with commercial real estate in major cities. I mean, shoot, I was reading an article last year, and I think we talked about it on one of our videos, that a big commercial real estate investor just let go of a $600 million real estate investment. It was over $600 million. They just gave it back to the bank and said, here you go. We're not going to, no longer is this investment going to remain profitable. So we should start to see that take place as the year carries on. And if interest rates don't come down very soon, we're going to see some damage coming from commercial real estate. And if we're seeing damaging for commercial real estate investors, those investors also own retail, or your single family, your multifamily. Those are all in the same category, essentially, for some of these investors. I'll bet, they are different categories, but the same investors, sometimes they invest into manufacturing. They're investing into developments. They're investing in single family, multifamily, different real estate. Some are buying flips. So when one sector of the real estate market is being damaged, it has pressure amongst all of real estate, but they're all doing a little bit different things. Just because your commercial is coming down doesn't mean your single family homes are coming down at that same pace, and maybe even more money flows into there. So there's quite a few different dynamics will be at play. But here's why all of real estate may be affected by commercial real estate, and it has to do with the source of the financing. Banks, especially regional and smaller banks, they lend to the commercial real estate investors. They lend to real estate investors across the board. They lend to businesses. If they're getting hurt by non-payment or just letting the commercial real estate go back to the bank, that kills their balance sheet. And that makes them less likely to lend during difficult times, even if interest rates are coming down, because they're damaged. So if we're having a banking issue, that has major consequences on U.S. consumers, U.S. businesses. They can't get credit. They can't get money lent to them. You want to go apply for another credit card? Denied. We're being damaged by commercial real estate investors. We can't afford to lend credit right now until things start to resolve themselves. That banking issues can cause issues with our trading partners, European Union, Eurozone, Asian countries, Japan, South Korea. And we look at another announcement that we just got yesterday was Japan's in a recession. Germany is likely in a recession. The Eurozone is very close to a recession. Again, and that has consequences to banks all over the place. So we're going to see a lot of banking issues and pressures going into the rest of this year because of commercial banks are in the emerging markets and the euro economy are being damaged right now. How long will the U.S. economy hold up until we start to feel the ramifications from all of that? And if banks aren't lending, we're going to have a problem in the U.S., the consumers, the businesses at some point. So, but again, what does the Fed do? Do they just cut rates right now and risk inflation coming back, and then we have another 3-5 year long battle, possibly 10 years, a decade long battle with inflation? Or do they push the economy into a recession, and then they can flip on a switch by cutting rates and try to bring the economy back out of recession, yet there's economic damage, people are hurt by it. There's no really good scenario, but I think the Fed has made it very clear with each one of their meetings that they're going to fight inflation. That is their main concern. They have to defeat inflation. So if the economy tips into recession, they've stated they have the tools to bring us out, but we got to expect, especially because of this high inflation number, that they're going to err on the side of let's defeat inflation. So we'll keep you in tune. We'll teach you how to navigate. We'll tell you how we're navigating this market because it's going to be a wild ride in 2024. Stay with us. Expertise you deserve. Experience you can count on.